Mike Douglas is Michigan's retirement coach.
It's hard to believe that we're getting into this time of year where we got to start thinking about holiday. You and I, before we came on the radio today, I was saying to you, okay, so we got to remember to think ahead for our radio shows around the holidays when you're off for Thanksgiving and making sure that we have.
Because Thanksgiving's in like
plans.
6 weeks, 7 weeks. That's crazy.
If even. Is it even? Yeah.
It's right around there because it's a little bit of a late Thanksgiving.
Mm-hmm. And you've got 4 children, ages 14 to 10.
9, almost 10.
9, almost 10. So Christmas is a very big day at the Douglas household. It's a very expensive day at the Douglas household.
Well, and we also were talking, my oldest started driver's training. And he's already made the jokes about, well, maybe I'll drive us, because we drive to Delaware every year to visit my grandfather. He's turning 95.
Yeah.
And when we drive out there, Gavin already made the comment, well, maybe I should be driving out to Delaware.
Yeah.
I'm like, whew. Down the Ohio Turnpike or Pennsylvania Turnpike?
Listen,
probably not.
He's got to learn.
Yeah. Well, he does.
You're like, but not with his mother and 3 other siblings in the car.
Well, he said it on the first day of driver's training.
I like the confidence.
Like, easy, Butch. Like just back it down a little bit. It's our first day of driver's training. You're talking about driving down the turnpike.
I like it.
Which is going to happen. And I'm excited for him. I remember how exciting it was to be in driver's training and get behind the wheel and do some stuff. But it's just so funny because his first day was a Monday. And then they scheduled him for his first driving on Thursday. And I'm like, are you guys sure?
Yeah. That's right. You got to start. You got to learn them.
Yeah. It's exciting time.
It is exciting. Let's continue the confidence conversation and how confidence can shift, how it does shift. For so many of us, I joke with all of my friends and family, as you get older, the more you learn, the more you know, the more you realize how little you know.
Yeah. Yeah.
Ironically, it's a backwards trajectory of life.
The more you know, the bigger the universe actually is.
The more you realize how little you know.
Yeah.
So for so many of us, as I don't have to explain to you, Mike, how much we realize, especially as we get closer to retirement, that we don't know when it comes to our own money, our own savings. And after decades of working and saving, figuring out how to plan for our retirement years, just figuring out how to get ourselves paid in retirement. It continues to move. It continues to change. It's really changed a lot. Tools that are options for us over the last 5 years because of everything that's been happening with interest rates and all the different market volatility that we've seen for various reasons. So in the last few years, as we've seen interest rates go up, billions of dollars have been put into investment opportunities like CDs and money markets. Also, as millions of boomers are retiring, we've talked about that. Right now, we're in a phase where 10,000 boomers are turning 65 every single day. They're looking for income in retirement, and there have been a record number of annuities being sold each month. Now, an article in the Wall Street Journal is talking about how billions of dollars are pouring into dividend-paying stocks. Again, all of this stuff that I'm reading is all pointing towards we're trying to find ways to add income security to our retirement plans, Mike. So let's talk specifically about the dividend-paying stock option. I mean, obviously, the appeal is the dividends. How are you using them at Life Plan Financial Design in the plans that you're building out?
I remember about 5 years ago, we moved into this new neighborhood so we've always lived in the country. Kimberly grew up in the country.
Yeah.
We've always lived out in the country, and we've had dogs. And when you live in the country and you have a dog, they're great because they go out, they go to the bathroom, they play, and then they come back inside like nothing.
Right.
And that's been our life experience. Well, then we moved into a neighborhood for the first time in our married life. And we moved into this house that there's a house across the street and then a house on the other side. So it's kind of like at a T intersection. Mm-hmm. And our dog that was always a good, well-behaved dog, now that we live in this neighborhood.
I feel the story turning. What's your dog's name?
Satchmo.
I feel like Satchmo's getting ready. The story's turning on him. Okay.
Yeah. So the 2 houses, the one across the street and the one to the left of us, they both have dogs as well.
Okay.
So now when we let Satchmo out to go to the bathroom, 3 in the afternoon, 3 in the morning, it doesn't matter. He goes out, goes to the bathroom, then he goes to the corner of our yard and barks at the other 2 houses.
Sure.
just to let the other dogs know that he's outside and that they're not, and that he's the alpha. Now, Satchmo is a Yorkie Shih Tzu mix.
Okay,
he's
so
like
a little
15
buddy.
pounds of fury.
Little buddy. Okay.
And then he'll come inside, and then not too long after that, shockingly, the next door neighbor's dog has to go to the bathroom, and he comes outside, and he barks at our house. And he's a cute dog, bigger than our dog.
Uh-huh.
And then to the house to the left of us, they have a big black Great Dane named Bella.
Wow.
And then that dog will come outside because it has to go to the bathroom and it will bark. And we have these 3 dogs. And if they're ever all outside at the same time, pandemonium. It's crazy. But yet they all have these collars on them that keep them from doing anything about it.
Okay.
You know, they have to stay in our yard.
Okay.
And that's for the sake of the neighborhood, for the sake of any jogger who happens to come
For the
through,
sake of
right?
the
Like
dog,
all these dogs.
Yeah, there's lots of safety reasons.
But so they go to the edge and they just bark at each other, trying to tell everybody that they're the alpha.
Mm-hmm.
When we look at retirement, there are these 3 worlds of money that all want to bark at us and tell us they're the best thing going.
Mm-hmm.
The first one is the Wall Street world, right? Like if you're going to get income in retirement, I'll tell you how to do it. You got to use the rule of 4%. Take your money, take 4% out, and the money should last you 30 years. And that rule has or has not been proven, depending on the studies you read. It's not as successful as it used to be. Or they'll say you have to buy dividend stocks. And I like dividend stocks, by the way.
Mm-hmm.
And so I want to make sure, like, as we go through this, the frustration is when people are just telling you what you have to do, not asking what you want to do, because they're just barking at you. So the Wall Street world will tell you, use the rule of 4% or buy high dividend stocks. And that's the only way. And they'll tell you the other two worlds don't know what they're talking about. I'm the alpha. Then you say, okay, well, that's the one side. Then you go to the bankers world, and the bankers are like, no, hold on. Put your money in CDs and pull the interest off, and that's how you can live. But then you say, wait a minute. I don't know if I trust that CD rates are going to be this high for the next 20 to 30 years. They seem exceptionally high right now, and they've already been coming down. And that's why for a long time, we call them certificates of disappointment, because you buy the CD and then you get a 1099 at the end of the year, realizing you made 2% or whatever. So, and even now, you know, if you have the Lake Michigan Credit Union has nice ones. There's a lot of good CD banks around, but we know that rates are coming down because as they cut the Fed rates, then they're going to cut the bank rates as well. So that's the other world. And they're going to tell you, listen, we're safe and we're liquid and we can get you some growth. But then when you say, okay, but can you guarantee me that I can get 4 to 5% for the next 30 years? No, they can't do that.
Right.
So, okay. And then, so that's the second world. You have the Wall Street world, the banking world, and then the third world's the insurance world. And it's where you get these annuities. The annuity salesmen come in and they start telling you, well, yeah, just buy an annuity and you'll never have to worry about another thing the rest of your life. And you say, that sounds incredible. Is it safe? Yeah, some of them are safe. Some aren't, though. If you get variable annuities, there's risk to your principal, but the income is safe.
Okay.
All right. Well, is it liquid? No, you can't take your money out. You can take out up to 10% per year, but then it reduces your income. So there's limitations. Can it grow? Yeah, some of them can grow. Some of them won't. So there's no perfect investment, but yet you got these 3 different worlds barking at you. The Wall Street people tell you don't listen to the insurance people because they're salesmen, conmen, and don't talk to banks because they won't make any money. The bankers will tell you that Wall Street's going to lose you everything and that the insurance people are going to tie your money up, so keep it there. And the insurance people just tell you, why would you ever risk losing money in the market? Put it here in the insurance world and be happy. And, you know, it's all sunshine and roses apparently in the insurance world. The frustration is that sometimes the annuity makes sense. Sometimes the dividend paying stocks make sense. I think there's a certain amount of money you should have in the bank, and it's a comfort number. It's I sleep better if I have this much in the bank. And yet we're told that there's like that each one of them is the only solution. What you have to be able to do is stand in the intersection of these 3 worlds and say, all right, I probably need some money in the bank because I feel better. I need so much money in the market, and maybe it makes sense to potentially get an annuity for income. But you have to understand the pros and cons of it. There's no perfect annuity.
Right.
Yeah, there's no perfect stock portfolio. There's no perfect banking scenario. They are all bringing their best efforts to get all of your money. And yet a true fiduciary mentality, even over your own money, not just like as an advisor, but if you're going to be a fiduciary of your own money, I think it would be smart to have the understanding that, you know what, there's no perfect money world. I probably need a piece of different worlds. And that's how we build you can build a perfect portfolio, even though there's no perfect investment. So that's what we want to look at. Understanding that if you felt this way and you've been sold, or you feel like you're being sold, and you feel like every time I just try to say what I want, I'm told what I need, not asked what I want, give us a call. We can help you navigate this thing the right way. And we'll make sure that you don't ever feel sold, but instead you feel educated in that the thing you want and makes sense gets to you. Give us a call, 616-512-2127, or you can reach out to us at michigansretirementcoach.com. Let's go through real quick the different options and the pros and cons, because there is no perfect thing. Okay. Yep. So I know we're going to land on high dividend stocks because I really like them.
Okay.
But I want to make sure we cover all of them. So annuities, there's goods and bads, the pros and cons. The pros, you get guaranteed income for life, contractually guaranteed regardless of the market. When you get an annuity, you are saying, I'm going to put some money into this investment. As long as me or you and your spouse are living, the same paycheck will cut every month, every time the rest of your life. That's the pro. Well, what happens if my account balance drops or the market drops? It doesn't matter. The income's contractually guaranteed. That's a beautiful thing. It can act as a true retirement paycheck. The cons, you cannot get that money back out. You put it in there. Now, the good kind, there's still cash there as a death benefit for your kids. Like if something happens to you, if something happens to me and Kimberly, and there's still cash in that annuity, that cash goes to my kids. There's kinds that I don't care for. And when you annuitize, the insurance company gets to keep your money, and don't get sold one of those. But for the most part, the good ones say my kids get what's left. My wife and I get income the rest of my life. But there's not good liquidity out of those. And depending on your age, if you try to retire young, a lot of times annuities don't pay out very much because they know they have to pay you for 35 years.
Yep.
So they're not going to pay you a whole lot.
Yep.
But if you're in your 60s into 70s, the payout factors are pretty high. So it's really got to be for the right person at the right time of life.
Okay.
And unfortunately, we're told, hey, everybody needs an annuity. I struggle with that concept, but I do think it's valuable to understand how they work and if it fits. When it fits, it's great to cover your essential expenses and give you some peace of mind. An annuity turns part of your savings into a personal pension.
Got it.
If you want to understand if annuities make sense for you, give us a call. Or if you have an annuity and you say, am I in the right kind of annuity? We can help you. We'll run an annuity x-ray and let you know exactly where you sit. 616-512-2127. So that's option one, is putting your money into an annuity. Don't put it all in there, but you may want to put some into one.
Okay.
The next thing, let's talk about the banking world. So what banks are good at is using your money to make money. Now, I love my credit union. I love it. They've been very good to me. I've been with the same credit union since I was 16 years old.
Okay.
So I'm a lifer.
And Mike is an Army kid. You should know. So I was going to say, where is your credit union located? You guys moved a lot when you were growing up.
I was so in the world of Army brats, I was born on the Dover Air Force Base in Dover, Delaware, moved to Fort Benjamin Harrison, Indiana when I was 9 months old, and moved to Lansing when I was 5.
Okay.
And then we stayed because my dad retired.
Oh, that's nice. Okay, good.
So blessed that way.
Yeah.
And, but also typically Army people don't get attached to stuff because you're moving so much.
Yeah.
But yeah, so I've been with the same credit union since I was 16 and I love them.
Got it.
But I do not have them handle my investments. What they handle for me is my liquidity, right? So there's a certain amount of money that Kimberly and I like to have in cash that we can get access to, a line of credit that we can use if something big should come along. So we use our bank for when we need to finance or when we need to lean into some liquidity options. I do not use them for my investment space. But I do know this. When we look at the bank account and see a certain number in there and we're going on vacation, I love the fact that we could just pull out cash and go if we need to. Sure. There's a great value in that.
Yeah.
And even the advisor in me says that money should be making more money. I get it. But I also come from a military poor family, and there's a value to having comfort with your cash level. And so while the spreadsheet says I should be getting 6 to 8% on my low, at my age, whatever, I get it. But I just like the feeling of seeing I have this much in there. If something happens on this vacation, I can cut a check, pay for the transmission on the car to be redundant. Like we're good.
Yep.
So that's, everybody has a number. Yep. Some people it's 10 grand. Some people it's 100 grand, whatever it is. Mine's not 100 grand. I like keeping money in the market, but but everybody has a number.
But you're a
and
certified
keep that number in
financial
the bank.
planner. It's a different perspective for you.
Yeah, my whole life is around the stock market. So that's that one. And then the third world is the stock market world. How do I get money out of the stock market? Well, for a long time, since like 1995, we were told, put all your money in the market, get like a 60-40 portfolio, and pull 4% out, and you'll be good probably the rest of your life. For 30 years, you'll have money. So if you have $1 million, you put it all in the market in a 60-40 portfolio, and you're going to be able to get 40 grand out the rest of your life probably and make the money last, which sounds good, except for when the market crashes. What if you retire and the market crashes the first 2 to 3 years of your life, of your retirement life? That happens. It happened to people who retired in 2000. Immediately, the market dropped for 3 straight years. Then over 3 years, it dropped 43%. And now you're taking 4% out per year. You're doubling down on a losing asset. And so as the market drops, you drop it further by pulling money out. And then you have to realize that as it's coming down and you're making it worse by pulling money out, it's going to take longer to recover. There are some catastrophic marks that you just have a hard time recovering from. So we just have to be careful of that. But the one I really like out of the stock market is using a portion of your portfolio to buy high dividend stocks. Something that's going to pay out a high number, not too high. But I like it if I say, you know what? Here's 25 companies that have paid a consistent 6%, 4 to 6% dividend over the last 25 years. Okay, did they keep paying their dividends through COVID? Did they keep paying their dividends through the great financial crisis? Did they keep paying their dividends through the tariffs? Yes. Then I like them because they've stayed steady. They've stayed the course through black swan events, and they will pay you a good number. And it's not hard to build a 6% dividend portfolio. So 6% on your money. So you tell me which is better, taking 4% out or 6%. Mm-hmm. Well, 6% is obviously better. So on the same $1 million, you can get $60,000 a year to live off of rather than $40,000. To me, I think it's a no-brainer. I don't care for the rule of 4%. I would rather use a dividend position or an annuity position to cover my essential expenses, what it means to keep my lights on, what it means to keep my life going. At the same time, I want to use the market to cover my growth and my someday money and my vacations and my other stuff. So I just think we need to understand the pros and cons.
Yeah. High
dividend stocks, the higher the dividend, the more volatile the price will be. And the more your stock portfolio will fluctuate, and you will lose money sometimes and you will make money sometimes, but the dividend checks tend to still clear. You just have to be really careful about just going all in on any of these things. The problem is when you are a person and you're trying to understand all this stuff, it's hard to make sense of it all. And that's where working with an independent advisor comes in. We do not have the big box firm model, which is buy our product only and then deal with that. You know, especially frustrating when you go and you hear from some of these bigger firms and they say, well, we're going to do this and that. And you find out that they own the two different companies. They own the insurance company and they own the stock portfolios, and you're stuck with both. Don't be sold into someone's products. Instead, work with an independent advisor who can build a successful plan. And then the products will kind of come and go because if stocks are good, stocks are bad. You know what? Yeah. It doesn't matter which one you're using. The plan is what's the most important piece of it.
Right.
So the right plan isn't about picking sides. It's about balance. This is what it means to have a successful retirement plan, to understand where income comes from, how it affects your life. And at the end of the day, we need income to go golfing, to go traveling, to snowbird, to do the things we've always wanted to do. Don't be sold into things you don't want or don't need. Instead, live the life you've always dreamed of living, but yet do it on your terms. To have that understanding, if you want to have that conversation, give us a call, 616-512-2127. We'll schedule a time for you and I to talk, to hear your story, and to answer any questions you have. That's how you can know that you're in the right place at the right time. 616-512-2127, or reach out to us at michigansretirementcoach.com.
When it comes to figuring out an income strategy for retirement, there are a lot of options. It can feel complicated and overwhelming, but at Life Plan Financial Design, Mike and his team are here to show you what options will work for your plan, for your goals for the years ahead. Again, him and his team being independent from big banks, from other financial advisory firms, are independent fiduciary financial advisors. And so they are here to help you. Also local, here to help you figure out how to reach your goals for the years ahead. So again, that number to dial is 616-512-2127. That's going to set up a time for an initial 30-minute phone conversation with Mike. This is a no fee, no obligation initial conversation, just you and Mike on the phone. You can express to him your questions, your concerns about your retirement plan. He'll explain to you how they might be able to help at Life Plan Financial Design, help you figure out these concerns and build a plan to help you reach your goals. 616-512-2127. If you're 5 to 10 years from retirement, if you've saved $500,000 or more, this is where you're really going to see the power of this kind of planning take effect. You can also go to our website, michigansretirementcoach.com, and click on the button that says start your retirement roadmap today to begin that way as well. Or call us right now. Let's put a time on the calendar for your no fee, no obligation phone conversation with Mike. 616-512-2127. All right, everybody, get out your pencils. We're going to do some schooling here about a concept that you might have heard about, but it can often lead to confusing conversations. Tax loss harvesting. Nobody wants to lose money on investments. Market risk is something that we're all very concerned about in our retirement in particular. But in the case of stocks, it can be a silver lining when combined with the right kind of tax strategy called tax loss harvesting, because it creates an opportunity to reduce your federal income tax liability. So first things first, can you just try as basically as you can to explain what tax loss harvesting is?
Yeah, so tax loss harvesting is understanding that sometimes selling something at a loss can be beneficial if it can get rid of a gain. Think of it that way.
Okay.
We have, when they have like the scales that you would put, like as a young kid in school, you learn like, oh, if I put so many green beans on this side,
Yep.
and so many, something else, Cheerios on this side. Yep. How many green beans is the same weight as Cheerios? Mm-hmm. And you would do something like that in a science class. In the same way, when we're looking at taxes in your portfolio, sometimes we can weigh out the scale in a way where we pay nothing. If nothing in taxes means that everything's even, both sides of the scale are even, mm-hmm. then I don't pay any taxes. Well, for example, we had a client who she sold a rental property. It's a property they had for 20 years.
Okay.
So what happens when you own a rental property, you buy it she bought hers for about $140,000, and she rented it every year. And one of the strategies a CPA uses, which is great, is you depreciate the property year over year mm-hmm. to help eliminate some taxes on the income you earned. So when you do that, she bought it for 130, but every year that the CPA depreciated it, it's like she bought it for 125 and then 120. So over the years, they lowered what she paid for it down to zero. So when she goes to sell it for $200,000,
yeah,
she pays taxes on the difference between the 200 she sold it for and the zero that she paid for it. Not because she actually paid zero, because year over year, the CPA depreciated it. She owes taxes on $200,000 worth of gains. So on one side of the scale, she had the sale of her rental property, $200,000 of long-term capital gains. Mm-hmm. If nothing else is done, she owes $30,000 in taxes there.
Okay.
All right. Then on the other side of the scale, she has her brokerage account. It's just a stock account that she inherited from her parents. Mm-hmm. It's non-qualified. It's not in an IRA or 401k. It's just a bunch of stocks that her dad bought that then she received. When she received it back in 2010, she got what's called a step up in basis. It's as though she bought all those stocks in 2010. She had some that went up, some that were down. And as we looked at it, we said, all right, are there any losses in this portfolio that I could put on the other side of the scale to cancel out the $200,000 of taxable income from the sale? We went through and we said, all right, out of these mutual funds you have, some of her bond positions were at a loss. So we were able to sell $200,000 worth of long-term capital losses in mutual funds, put that on the scale against the other side, which is her rental property sale. Mm-hmm. And she owed zero in taxes because the things balanced out.
Okay.
But yet when she asked her realtor, when she was getting ready to sell the property, she goes, man, I don't want to pay a bunch of tax on this. He goes, well, just buy another property, roll it forward. It's called a 1031 exchange. You sell a real estate transaction, and within 6 months, if you buy another piece of real estate, you can roll the problem forward, kick the can down the road, put those gains in the new house, which means that if you sell that new one, you have even more taxes. She didn't want another rental. She's getting out of the rental game. She said to quote her, I aged out of it.
Yeah.
I don't want to do it
It's
anymore.
a lot of work.
Yeah. And that's fair. So what we did is we found a way to even the scales in her favor.
Mm-hmm.
Now, what's funny is she went to her CPA because she wasn't a client of ours yet. This is someone, she just came to one of our tax education workshops.
Okay.
So as we're going through and talking about it, she goes to her CPA and says, is it true that if I sell these mutual funds at a loss, it will get rid of the taxes? He said, absolutely. And she said, okay, should I sell them? He said, I can't give you advice on selling mutual funds. I'm a CPA. I'm not a financial advisor. I'm not securities licensed. I can't tell you whether or not to sell. Yeah. I can just tell you that math works out.
Okay.
He said, you need to go across the hall because her financial advisor and CPA work in the same building across the hall from each other.
Should be convenient.
Yes.
And yet
she goes across the hall and talks to the financial advisor. He says, why would you want to sell this at a loss? If you sell it at a loss, you're locking in the losses. Yeah. You're guaranteeing that this will never come back. Yeah. Why don't we think of it this way? They're at a loss now, which means that there's a great way for them to go back up. Like there's room for them to go back up.
Mm-hmm.
And she said, but if I sell it at a loss, I don't pay taxes over here. And if it just lost me $200,000, why would I want to keep it?
Right.
He didn't have a good answer for that. So she said, so do you think I should sell it? He said, I can't give you tax advice. I'm a financial advisor.
Mm-hmm.
So she was left in this position of nobody would say yes.
Right.
Everybody says, talk to the other guy.
Yeah.
At least her CPA said the math works. So she came back to us and said, is there any other stuff like this in my portfolio I should be doing? So we went through and I said, you've got some things here that have been losing you money year over year. Why are we still holding on to them? Well, because I didn't want to sell at a loss. And by the way, if this is you, where you have a CPA and a financial advisor, but yet you're left to be the one to play operator.
Nobody's giving me an answer.
Game?
Yeah.
Yeah. Like you're playing telephone where you're relaying messages between them.
Yeah.
And then throwing an estate planning attorney and then throwing a realtor. Like it's just tough. If you'd like to have a conversation with someone who does everything in the one spot, give us a call, 616-512-2127, and we will help you build a plan that coordinates all of these things, and you can stop playing CFO and go back to retiring. When we went through this plan, not only were we able to save the $30,000 in taxes on that she was just going to pay because she was told there's no other options besides buy more real estate.
Mm-hmm.
Then we went through the rest of her portfolio. And she said, I really like some of these stocks my dad bought, but I can't afford to do anything with that money because there's too much in gains. We went through her portfolio, found more losses. We were able to sell some of the other things that were to gain, even the scales out across the board, because she wanted to rebalance the portfolio, buy some more of the good stuff, get rid of some other things. Mm-hmm. But she said, I can't because there's too much in taxes inside. Well, it didn't take long. It took us about 2 meetings to go through and identify the fact that she could actually rebalance the portfolio the way she wanted.
Yeah.
By using the scale. Stack some gains on one side, stack some losses on the other, and sell them both, and then do it. Now, the biggest mistake people make with tax loss harvesting is not understanding the wash sale rule.
Okay.
There is a penalty you will pay if you sell something at a loss and then repurchase it to try and get a lower cost basis. You can't do that. You can't repurchase the same stock that you just sold at a loss for 30 days.
Okay. After 30 days, you can?
After 30 days, you can, but you need to know these rules because it's easy to avoid, but it's also easy to do on accident.
Yeah.
Because we just want to sell a loss and sell a gain and balance the scale. Follow a couple of easy rules. These are the conversations we have. Retirement is about keeping as much as possible out of what you have earned and saved or what you've been blessed with by your family. Mm-hmm. That is a good retirement plan. You will not get this advice from big box firms on 800 numbers because they can't. They will tell you, talk to your tax person. It'd be nice if for once in your life, you could just sit down at one conference table and the professionals come to you rather than you go chasing down the professionals. At Life Plan Financial, we go through and say, you sit down here, we will bring everybody to you. That way, everybody's on the same page. If that's what you'd like to walk through and see what that looks like for your retirement, give us a call, 616-512-2127, or reach out to us at michigansretirementcoach.com, and we will set up a time to hear your story and make sure that you can stay retired.
We've got a teammate standing by right now, ready to answer your call off the air and help you schedule a time for your initial 30-minute phone conversation with you and Mike. A no-fee, no-obligation conversation, just a space to ask some initial questions, and he can explain to you how he and his team might be able to help. Again, it's 616-512-2127, 616-512-2127 to set a time for your 30-minute phone conversation with Mike. 616-512-2127. You can also find us anytime at michigansretirementcoach.com. We're going to give you a minute to make that call while we take a quick break. Then we'll hear from a doctor who has spent her career with people in their final days. She's going to share the top regrets she hears most, and it might just change how you think about retirement. We'll talk about that when we're back with more of Michigan's Retirement Coach on Wood Radio right after this.
Thanks for listening to Michigan's Retirement Coach with Mike Douglas. To learn more, visit michigansretirementcoach.com.
Michael Douglas is an investment advisor representative of Stewards Wealth Planning, LLC, a registered investment advisor. Financial professionals are not licensed in all 50 states. To find out if Michael Douglas is licensed in your state, please call 517-323-7526. Stewards Wealth Planning, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Michael B. Douglas, NPN number 9650939.